So, welcome to today's Fundamentals and Technicals. My name is Peter Yusuf, Senior Market Analyst at IronFX, starting with Euro USD. It's the 4-hour chart. All charts to be presented are to be of the same time frame, unless otherwise stated. I was already working on the chart as the ads were playing. And at this point, I would be noting the wide drop of Euro USD yesterday, which actually broke the S1 1.0635 and returned to the levels before it started to rise practically 2 days ago. So definitely the first action would be to reverse the role of the support line into resistance line, given that the price action has moved below it. And let's go hunting for a new ultimate support line. Let's add also some toolbars, starting with standard charts, line studies definitely, and definitely time frames. There you go. Let's unlock the chart, go back and see where we can find relative true peak, which we could use as a new support line, ultimate support line. Okay, there's a nice true here, but it's still way lower. Actually, it's pretty close to the S2, so I'm going to be skipping that. On the other hand, though, we have to note here that, well, that would be better. And I'm selecting this peak here as the next possible resistance line, support line. In green. Let's readjust and have a look how that plays out. Okay, we have a very wide distance here between the S1 and the S2, while a very narrow one between the S2 and the S3. I'm going to be keeping it. Okay, I know it's asymmetric, but in my opinion, that's not what matters here. The true we have found was very interesting in my opinion, and I'm keeping it. Let's correct also the labels and finally adjust the S2 and the S3. Starting with the R3, which is now being placed at 1.0935, the R2 at 1.0770, the R1 at 1.0635, the S1 at 1.0460. Now we're going to be adjusting the S2 slightly. It's actually at 1.02294. I'm going to be switching it to 1.0225. Allow me to recheck once again the validity. Yep, beautiful touch here. Now some have argued that it could go even as high as here, but in my opinion that's more valid as it incorporates practically all this sideways motion here as a as a low boundary. On the other hand, let's have a look also at the S3. Once again here, 1.009. Yep. Okay, let's readjust the chart. Once again, add the labels. And 1.0090. 10 too much. There you go. Okay, despite the price action of Euro USD dropping and breaking the R1 1.0635 now turned to resistance, we have conflicting signals here. On the one hand, you have an upward trend line which seems to remain intact. On the other hand, though, note how the RSI indicator has reached, and it's actually slightly below the reading of 50, yet it's still unconvincing for any bearish sentiment in the market, more likely to be a rather indecisive market. So I would expect in the short term the pair to remain in a sideways motion, maybe edge a little bit lower. The crucial element here, though, is whether the upward trend line will be broken or not. Should that be broken and the price action remains in the corridor set between the S1 and the R1, the 1.0460 and the 1.0635 respectively, then we may be talking about a sideways motion and the stabilization of the pair. On the other hand, should the pair once again be able to breach above the R1 1.0635 and start aiming actively for the R2 1.0770, then we would be talking about a possible bullish outlook. Mind you that we have ECB's interest rate decision tomorrow, which is going to be quite interesting and may create substantial volatility for the pair. For a bearish outlook, we would require the pair to drop, break the pre-mentioned upward trend line, once again signaling that the upward movement has been interrupted. But for a bearish outlook, we would be also requiring the pair to move decisively lower than the S1 1.0460. I would require a higher true than this one, which was practically the beginning of the upward movement. So the pair has to break the upward trend line, break the S1 1.0460 and start aiming for low grounds. That's for a bearish outlook. Once again, for the time being and in the short term, in the next 24 hours, we tend to maintain a bias for the sideways motion to continue. Mind you that some bearish tendencies may appear. I wouldn't be surprised, especially should the RSI indicator move decisively lower than the reading of 50 and start approaching the reading of 30. That would be also signaling the switch in the market sentiment from indecisive towards bearish. On the fundamental level, I think the release of yesterday's preliminary PMI figures for October were very indicative and tended to more or less provide some support for the USD side of the pair. We have to note here that we had the preliminary PMI figures, which, okay, they were somewhat improved for the Eurozone as a whole. However, it was more like being rather mixed. And I have to note here that the main element, or the two main elements which I would be highlighting here, was A, that we had another contraction of economic activity throughout the Eurozone. And at this point, it would be interesting to note that we had also Germany's services PMI figure dropping below 50 decisively, implying a contraction of economic activity also in the services sector. While the drop of German services sector also forced the composite PMI for the Eurozone as a whole now to drop lower, implying that there was a deeper contraction of economic activity on average across sectors and across borders in the Eurozone. On the flip side, we had the US GDP rate, the US PMI figures, the preliminary ones for October, which were better than expected. Actually, were above 50. And that implied an expansion, even a slight one, of economic activity in both the services and manufacturing sector of the US. It was very, very positive, in my opinion, regarding the US economic outlook. Given that, if I'm correct, there is no PMI in the Eurozone, in the UK, and China, which are clearly above 50. Both manufacturing and services. And I think the same applies also for Japan. However, I'm a little bit uncertain there. I will have to check. And overall, the release, in my opinion, highlighted the positive divergence for the US economy in comparison to other economies. Practically, the US economy has a better outlook. And that was the key takeaway from the release yesterday. Let's have a look also at cable, which had a relatively similar move, however, not to the same extent, I think. Yep. Note how GBP USD also edged lower, which was also a result of the preliminary PMI figures of October. And however, at this point, I would be noting that cable's sideways motion seems to be maintained between the 1.2325 and the 1.2065. So we're talking about a 260 pips spectrum here. It's pretty wide. However, the pound is quite volatile and could easily breach it. For the time being, we tend to maintain a bias for the sideways motion to continue, yet at this point, in contrast to the Euro USD, bearish tendencies in the market sentiment, seem to be intensifying. It's characteristic that the RSI indicator has abandoned the reading of 50 and is moving towards 30. Yet for a bearish outlook, I would require the pair to break clearly the S1 1.2065. I would require a lower truth on this one and start aiming for the 1.1925. On the flip side, however improbable that may be, it's still a possibility and should be covered. For bullish outlook, I would require a higher peak than this one. So practically, the pair has to rise, breach the R1 1.2325 and start aiming for the 1.25 something, which does not seem to be quite probable, at least for now. It would require a substantial weakening of the USD side. Because on the GBP side, okay, there's not much going on anyway right now. Okay, let's have a look at USD/JPY. USD/JPY was able to rise and reach once again the cutoff point of R150. It hasn't breached it, but it has risen and practically corrected the correction lower, which was instigated the day before yesterday. Let's have a look, just to be sure. Yeah, on the 23rd. So more or less, it's a make or break position for USD/JPY as it remains below the downward trend line. So more or less, we do see the possibility of a sideways motion continuing at this case. The RSI indicator is a little bit higher than the reading of 50. It's actually right now at 57. Okay, there are some bullish tendencies, but let's not underestimate the market worries that BOJ or the Japanese government may intervene should the pair break above the 150 threshold. That would be a level of weakening for JPY, which may instigate a market intervention. Once again, we tend to highlight the possibility of a sideways motion just below the 150 resistance line. Let's have a look at AUD/USD. That's better. Now, AUD/USD had risen, corrected lower. And at this point, it would be interesting to note what the market reaction was at the release of Australia's Q3 CPI rates, if there was any. Allow me to drill into the minute chart. Unlocking it. Here it was. Interestingly enough, AUD USD rose around 26, 28 pips, which is notable. And that was despite Australia's, back to the 4-hour chart, CPI rates slowing down for quarter 3, maybe not slowing down as widely as was initially expected by the market. And I think even the slight, not uptick, but even the slightest divergence here to the upside instigated this market reaction. It took the markets by surprise. So for the time being, though, we're noting that AUD/USD is correcting now lower. Overall, the price action verified the validity of the 0.64 resistance line. You can see it, how it was tested here. Once again, let's drill into the minute chart, unlock the chart, widen it, go back. See how it was rising from the release of the CPI rates, rose continuously, reached the 0.64, and then started to correct lower. Back to the 4-hour chart, readjusting. There you go. For the time being, the sideways motion movement seems to have been confirmed. Market sentiment, albeit becoming a little bit bullish during today's Asian session, has corrected lower and is now practically, the RSI indicator is now at the reading of 50, implying a rather indecisive market. I wouldn't be surprised to see the RSI indicator edging a little bit lower, which may allow AUD/USD to correct even lower. But overall, I would expect it to remain in the spectrum set between the R1 0.64 and the S1 0.6285. For a bearish outlook, we would require a clear breaking of the S1. Mind you that the S1 is pretty valid. We had a confirmation once, twice, 3 times here. And start aiming for 0.6165. On the flip side, for a bullish outlook, we may require, or not we may, we will be requiring the pair to rise, break the 0.64. Mind you that it was verified here and here, despite a significant breaking here. Nevertheless, we would require the pair to break the R1 and start aiming for the R2 0.6510, which reversed the upward motion beautifully here. Once again, base scenario for the Aussie being set at a sideways motion between the R1 and the S1. On the fundamental level, the slowdown of the CPI rates for quarter 3, despite not hitting, not reaching, not dropping as much as the market had expected, I would still note the easing of inflationary pressures within the Australian economy, which would or may, if you prefer, allow RBA to maintain rates unchanged and not to proceed with another rate hike in its next meeting, which most probably will be in not next Tuesday, but Tuesday the 7th of November. Let's have a look. 31st. Yeah, the 7th. Okay, let's have a look now at USD CAD. USD CAD, which has been on the rise, and this is decisive move upwards, which should not be neglected. Definitely, the R1 has been breached, the 1.37, and now turns into a support line. Let's color this in green. Let's go also hunting for a new ultimate resistance line. This is a nice peak at 1.3975. I would like to have a look also at the daily chart to see the big picture here. And there's clearly an upward movement here forming. Let's drill back to the 4-hour chart. Yeah. Okay, let's correct also the labels. Starting with the S3, which is now being placed at 1.35. The S2 at 1.36. The S1 at 1.37. The R1 at 1.3785. The R2 at 1.3885. And the R3 at 1.3975. For the time being, we tend to maintain a bullish outlook for the pair. And that's being based practically on, give me a sec just to clear up the chart. We tend to maintain a bullish outlook, and we base this outlook practically on 3 factors. The first is definitely the upward trend line guiding the pair. And at this point, I would like also to note that I was expecting actually a deeper correction lower. USD CAD bulls did not allow a deeper correction lower to emerge. They promptly pushed the pair even higher. And note how it's once again flirting with the upper Bollinger Band. So one, the idea of an upward trend line being still valid and actually intensifying its slope to the upside tends to support the idea of a bullish outlook. That's the first element. The second element would be the RSI indicator, which is now nearing the reading of 70, implying a buildup of a strong bullish sentiment of the pair for the pair. And the third element would be definitely the moving averages. We have 3 of them here. It's in blue, the 20 moving average, in green, the 50, and in orange, the 100 moving average. All 3 of them are pointing upwards and providing support for further gains for the bulls. Should the bulls maintain control, then I would expect the price action to rise, break the 1.3785, and start aiming for the 1.3885. On the flip side, a possible stabilization could occur should the pair actually hit a ceiling at the R1 as it did back here. It was a beautiful reversal of an upward movement here. And 1.3785 was able to manage that, and I wouldn't be surprised to see that happening again. Yet, for the sideways motion to prevail, the price action has to remain within the corridor set between the R1 and the S1. The S1, which was also a prior resistance line, now turned to support given that the price action has moved above it. For a bearish outlook, the bar is pretty high. And for a bearish outlook, I would require the pair to drop, break the S1 1.37, but also breach the upward trend line, signaling exactly that the upward movement has been interrupted, and start aiming for the 1.36. Now, such a movement would require a substantial surprise on behalf of the market, and market focus of CAD traders, of Loonie traders, is now shifting towards BOC's interest rate decision later in the American session today. The bank is widely expected to remain the bank is widely expected to remain on hold. And it's characteristic that CAT OIS implied probability of around 94% for such a scenario to materialize. It's a wide support for the idea that the bank will remain on hold. So attention is expected to shift towards A, the accompanying statement, and B, BOC Governor McClellan's press conference later on. Now, should the document actually show some cautiousness, I wouldn't be surprised to see even some dovishness here that be included. And I'm highlighting this due to the easing of inflationary pressures as reported by the release of the latest CPI rates. And the CPI rates slowed down, which may be an indication for the bank that its current monetary policy settings are working. So I wouldn't be so eager to actually proceed with another rate hike. Definitely not just yet. On the other hand, we have to note here that the Canadian employment market, in my opinion, still remains rather tight. And that may allow the bank to proceed with another rate hike, but that would be in the future. Mind you that the market currently expects the bank to remain on hold up until around summer next year and possibly start considering cutting rates. Hence, should the bank actually remain on hold and issue a dovish statement, that could weaken the CAD somewhat, yet the market reaction may be more easygoing because it's a scenario which is widely being expected. On the flip side, should the bank remain on hold, yet the accompanying statement or BOC Governor McClellan's press conference allow for some hawkish elements to be released, that could provide some asymmetric support for the CAD. And that would be driving USD CAD substantially lower. Once again, for the time being though, on a technical level, I'm highlighting here bullish outlook. I think it's pretty clear. And I would expect the pair to break the 1.3785 and start aiming for the 1.3885, which would be up around 100 pips higher. Let's have a look at XAU USD. That would be gold. Gold, which seems to be consolidated. And it's very clear, and it has consolidated just below the 1.75 support line. That should be now colored in red. It's beautiful how the price action is verifying the level as a resistance level. And let's go hunting for a new ultimate support line. I would be noting this through here. A little bit far-fetched. Going as wide. I think though that's a pretty valid level. I know it's asymmetric. It has a wide distance between the support line, the second support line, and the newly third support line. But it's a beautiful throw which should not be neglected, and it should be in red, please. In green, please. Widening the chart just a bit. Let's correct also the labels. And we start with the R3, which is now being placed at 2060. The R2 at 2020. The R1 at 1975. The S1 set at 1932. The S2 set at 1900. And a pretty way off, the S3 at 1845. Let's talk about direction here. Direction seems to be clearly in a sideways motion, and that's being supported by two elements. The first would be definitely the consecutive breaking of consecutive upward trend lines, with the most recent one being just now, actually during today's European session. And the second element would be the RSI indicator, which has corrected and remains just above, but very close to the reading of 50, implying rather decisive market, which could allow the sideways motion to continue. At this point, it should be noted also that the Bollinger Bands have narrowed, implying far less volatility. Once again, could allow the sideways motion to be maintained. However, that's not definitive. For bullish outlook, I would require the precious metals price to rise above the R1 and start aiming for the R2, while on the flip side, the bar for bearish outlook is pretty high. I would require the precious metal to break the S1 1932 and start aiming for the 1900. I would like to see a decisive move lower before actually adopting a bearish outlook here. On a more fundamental level, it seems that the negative correlation between the US dollar and gold has not been on such a display for the past few days. We can see the USD making wider moves, especially in the past 2 days, yesterday and the day before that. However, that was only meagerly reflected in gold's price. Okay, let's have a look at WTI, which continued to drop, by the way, and was very interesting. We extend now our downward trend line and have to correct also the S1 as it has been broken, turn into resistance line, log in. On a fundamental level, I would be noting a couple of elements here. The first would be, okay, this choice is very beautiful. I'm going to be taking it as for the ultimate support line. It's set at 73.80, sorry. Locking it in, readjusting the chart. Now, on a fundamental level, I would be noting a number of elements here. The first element is definitely the fact that it seems that the easing of US sanctions on Venezuela and its oil has started to take its toll on oil's price. And I'm highlighting this because if you note the downward movement, which started about here, was on Friday, which was a bit later than what the US actually eased the sanctions. I would also be noting here, though, on the flip side, because, okay, definitely the easing of sanctions in Venezuela is going to be easing the tightness of the supply side for the commodities price, allowing the commodities price to actually move lower. However, I'm a bit worried here. And the main reason why I'm worried, the main reasons are practically two. The first would be the fact that AP yesterday reported another drawdown. Okay, it was narrow, but still a drawdown, implying that demand in the US oil market was not able to reach production levels. So it surpassed production levels and thus underscored the relative tightness of the US oil market. That would be one factor which may provide some support for oil prices. I would be highlighting at this point the release of the EIA crude oil inventories figure later today in the American session, which could create some volatility for oil price. On the other hand, I would also be highlighting still the Israeli conflict. It could flare up and escalate at any given moment, and should that be the case, we may see oil prices jumping asymmetrically higher. But for the time being, and as long as the price action remains below the downward trend line, we tend to maintain a bearish outlook on a technical level, given also the fact that the RSI indicator has reached and remains near, just above, the reading of 30, implying a strong bearish sentiment. I wouldn't be surprised to see the price action of WTI breaching the S1 81.70 and start aiming for the 77.50. That should sum it up. From all of us here at IronFX, best wishes for solid trading.
Hello everyone, and welcome to another educational video. In this video, we look at the three main US stock market indexes. The S&P 500, Dow Jones Industrial Average, and Nasdaq Composite are the three most widely followed indexes in the US. The S&P 500 is an index with 500 of the top companies in the US. This index represents approximately 80% of the total value of the US stock market. Generally, the S&P 500 index gives a good indication of movement of the overall US market. The S&P 500 index is a market-weighted index, so basically every stock in the index is represented in proportion to its total market capitalization. This means that if the total market value of the 500 companies in the S&P 500 falls by 10%, the value of the index also falls by 10%. The Dow Jones Industrial Average is one of the most well-known and most frequently used indexes in the world. It includes the stocks of 30 of the largest and most important companies in the United States. The DJIA is a price-weighted index and represents about a quarter of the value of the entire US stock market. In general, the Dow is known for its listing of the best blue-chip companies. The Nasdaq Composite Index is a market capitalization-weighted index of all the stocks traded on the Nasdaq Stock Exchange. The technology sector accounts for just over half the index, more than 3 times the index weight of any other market sector. In addition to these 3 indexes, there are about another 5,000 that make up the US equity market. Hope you found our video interesting. Thank you for watching.
So today's session, as I mentioned earlier, is about trend trading. So as per usual, just a disclaimer before we get started. a risk warning. Our products are traded on margin and carry a high level of risk, and it is possible to lose all of your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. Disclaimer, the information in this webinar should not be considered investment advice and/or an investment recommendation, but instead educational material only. This material is just the personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. So IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. So I'm Melanie, and I will be your speaker for today. I'm an investment analyst from the company Everest Fortune Group, who were finalists for Best FX Research and Best Equity Research in the years 2019, 2020, and 2021. So here's our agenda for today. We have quite a number of slides to get through. So if you have any questions throughout the webinar, feel free to pop them into the chat or in the Q&A session, and I'll be happy to answer any questions you have. So this is our agenda for today. Firstly, we'll go through what exactly is trend trading and how to identify a trend using trend lines and channels. And then we will look at the different indicators that you can use and how you trade using these indicators. Next, we'll look at a couple of disadvantages of trend trading and how you can overcome these disadvantages. Okay, let's get right into it. So what exactly is trend trading? So it's a popular strategy used in Forex markets by traders to take advantage of the directional movement of currency prices over time. So as a beginner, understanding trend trading can help you to make more informed trading decisions. So trend trading is based on the idea that currency pairs tend to move in certain directions for extended periods of time before reversing. These movements can be upwards, referred to as an uptrend, or downward, which would then be referred to as a downtrend. So the goal of trend trading is to identify and capitalize on these sustained price movements. So statistically, a trend is more likely to continue than to reverse, and that's why a trend is assumed to be in effect until it gives a clear signal that it has reversed. Hence the sayings, the trend is your friend and you should never go against the trend. But of course, there are a couple of exceptions to this, so we'll talk a bit about those later on in the webinar. But the general rule is that when you follow these trends over different time frames and stay away from markets when they are not trending, then traders can then increase your profits by making these opportunities. So how exactly does it work? Excuse me. So here's just a simplified breakdown of how trend trading works and a couple of steps that you can take. So firstly would be identifying trends. So this would be an uptrend would be higher highs, and then a downtrend would then be lower lows. So this is typically done by analyzing historical price charts. Next would be your entry points. So once you've identified the trend, the next step is to find an opportune entry point. So over here, I've given an example of an uptrend. So during an uptrend, you might want to look to enter a trade and when the price has retraced slightly from its recent high. So this suggests that the trend will then continue. Alternatively, in a downtrend, you might look for a retracement before the price continues in its downward movement. Thirdly, we have setting stop loss and take profit levels. So to manage risk, it's crucial to set stop loss and take profit levels. So SL is stop loss, TP is take profit. Just to be sure. Okay, so a stop loss is a predetermined price at which your trade will automatically close and limit potential losses if the market moves against you. So this is also a risk management technique that we'll talk a little bit later. Next, a take profit level is where you decide to exit the trade to lock in your profits before the trade potentially reverses. Next, for number 4, we have riding the trend. So once you're in the trade, you have your risk management levels, so your stop loss, your take profit levels, all accounted for. Then, and your trend continues, then you can aim to stay in the trade as long as the trend remains intact. So this involves monitoring the price movement and adjusting your stop loss and take profit levels if needed. Number 5, exit the trade. So eventually you can expect the trend to reverse or weaken. So at this point, you might decide to exit the trade and take your profits, because it's important to note that trends will not last forever. So it's important to observe your trades and be vigilant and not get too greedy. Lastly, practice and analysis. So this is pretty self-explanatory. Like any trading strategy, trend trading requires practice and analysis. So you want to keep refining your skills by studying the charts and learning from your successful and unsuccessful trades. And of course, keeping updated on market news and events that could impact currency prices. Okay, so we talked a little bit about setting stop loss and take profit levels. So I just want to dive into that a little bit. So firstly, we have a retracement, which is what we talked about in the previous slide. So let's start off with pullback support and resistance. So pullback support is a strong level of support and it breaks out from a previous resistance level. Now price is dropping back to visit it again. So a tip is that when a pullback support lines up with a Fibonacci level, it's typically considered to be very powerful. Here we're talking a little bit about Fibonacci levels, but if you're a bit confused about those, not to worry, we have an entire Fibonacci series on the different types of Fibonacci's. So you can go ahead and take a look at those. But the point that I'm trying to drive here is basically the introduction of a pullback support and resistance for your that could be used as your entry and exit levels. So pullback resistance works well when it breaks a significant low, as you can see from the chart here. So it breaks the level and then it makes a significant swing low and then it starts to pull back to this level. So that's why we call it a pullback. So we advise that it's even better if there are multiple Fibonacci levels that are lining up with it. So here's an example of a pullback support. Here we have 3 swing highs that line up in the same area. So remember that these are typically areas, not so much levels. So we have 3 areas that line up and price has passed through this level and it looks like it's made a swing high and it's coming back down to bounce off of this level. Excuse me. So here we have, we're expecting price to bounce off of this level, and that's why we call it a pullback, because we're expecting price to pull back to this level. So this green area here is now considered a pullback support level. Okay, next, let's take a look at the pullback resistance example. In this example, we have 3 swing lows that line up in the same area, as you can see from this green area here. So the green area is our support, but once price breaks out of this support level, and we are expecting it to reverse off of it, then you can call it a resistance, a pullback resistance. Okay, so as you can see from the arrows, we're expecting price to pull back to this level here. So here's another example, but over here we have a actual example screenshot from a chart. So we have a swing low here and price is moving up. It's made a reversal over here. That's another way that you can identify trend reversals by looking at the swings, but we'll get into those in a little bit. So we have a swing high here, swing high reversal, it's going down, and then it surpassed the swing low support, And that's why we are expecting it to reverse back to this support level. But now that it's surpassed this level, it's now a resistance. So it is a pullback resistance in this case. Okay, next we have another pullback resistance example here. Actually, this is a follow-up from the previous slide. So this is the previous slide. We're expecting price to reverse off, and that's exactly what it did. So it reversed off of this swing low, reversed off, and it hit it right back to our pullback resistance, just as we expected. But what happens when price reverses off of this pullback resistance? So that's what we call a overlap support or resistance. So this overlap support and resistance basically occurs when price reacts off of a particular level from the top and from the bottom. So basically it means that when a swing low, as you can see from the GIF, lines up nicely with a swing high, then that's what we call an overlap level. So the more times that it reacts off of this level, the stronger the overlap area. This means that there are bulls and bears that are respecting this area. And that's why it's so important to take note of these areas. Okay, another pro tip, so if the overlap area lines up with other elements such as Fibonacci or graphical elements, it will make it even stronger. Okay, so here's an example of an overlap support or resistance. So it's basically a pullback support or resistance, just that price has actually reversed off of the level. Okay, so swing low support becomes a pullback resistance, as you can see from this screenshot. Once it breaks the support at this 105.643 level. So here in this GIF, you can see how price retraced back to this level or pulled back to that level, and then it proceeded to reverse off of that level. So once the reversal occurs, then it is an overlap resistance. Okay, let me know if there are any questions so far, but I hope this is pretty straightforward. Oops. Sorry about that. Press the wrong button. Okay, next slide. So now we're looking at a combination of the pullback and overlap levels. So here we have a big swing high resistance level, as you can see here at the first red arrow. And then it becomes a pullback support where we expect price to pull back or retrace this level once it has passed that swing high resistance. So it passes it, and then we're expecting it to come back to it. And that's why it is now a pullback support. Once price actually touches that pullback support and it reverses off of it or it bounces off of it, then we can call it an overlap support instead. Okay, you can take a look here for a while and let me know if there are any questions so far. But we do have a couple more examples in case you are confused. Okay, let's move on. So here's another example. We have multiple swing high resistance. You can see from the purple circles here, one swing high here and one swing high here. Next, at point number 2, I have an arrow indicated here. that's where price surpasses the resistance. So price surpasses the resistance, and then we call it a pullback support. So you can see how the resistance then changes to a support level once price surpasses it. So we are expecting price to pull back, and it did. So point number 3, price has pulled back to our support and has in fact bounced off of it twice. So at the blue circles, you have 2 swing lows that line up nicely with these 2 swing highs originally. Once price has bounced off of this level, the 0.68745, then you can call it an overlap support. Okay. Our last example before we get into how we can identify a trend. So our last example, pullback and overlap. Here we have multiple swing low supports, 1, 2 here, and then price has pulled back, or rather it has surpassed our support level, multiple swing low support. So it surpassed it, and we are expecting it to reverse back. We're expecting to reverse back because we have observed this swing low. Okay, so we observe the swing low, we see price approaching it, and we're expecting price to reverse off of it. And you can see that's exactly what happened. We have 1, 2, 3 swing highs that line up nicely, and they're all making it an overlap resistance instead. So we see price then break out of this overlap resistance one more time. In this case, since it was a resistance here, once it breaks out of that resistance, it's now a support level. And as usual, we're expecting it to pull back, which is why point number 4, it's a pullback support. And lastly, point number 5, price has pulled back to our support and reversed off of it, making it an overlap support. So you can see the swing low here, reversing right at the exact same 33420 support level. Okay, any questions so far? Okay, okay, no questions. Let's move on to our next part of the webinar. How do you identify a trend? So this brings us to our next point, which is identifying trend lines as well as trend channels. So these can really help you to identify a trend. But how you identify a trend is pretty straightforward just by looking at a chart. I'm sure you can tell whether price is moving up or down. And it's also important to note that you should be looking at the different time frames for the specific asset that you are looking at, and not just at the time frame that you are analyzing. So it's important to get an overall view of the direction of where prices are headed towards. So upwards, downwards, or ranging. Okay, so let's get into how we can draw valid ascending trend lines. So ascending trend lines should be drawn from the bottom and not from the top. So here we have an example. And trend lines should also have at least 3 significant touches in order to be considered valid. Because 2 touches tend to be more coincidental, and that's why we go for at least 3. Okay, here's a couple of examples to show you how significant exactly these swing lows should be. So I have one really big swing low here and one swing low here. So that's how clear your charts should be when you are analyzing for trend lines and trend channels. Here we have another example, 3 trend lines, or rather 3 points touching the trend line. Actually, we have another small point here. And now for descending trend lines. So same thing, a descending trend line should have at least 3 significant touches as well. But for descending trend line, the lines should be drawn from the top and not from the bottom. Okay, here's an example. Here we have really nice 4 swing highs that touch our trend line. Okay, once again, take note of how clear the price movement should be. Yeah, you want to look for something with really clear movement in price. You can see exactly where the peaks are and the troughs are. Here's another example of a descending trend line. So you want to watch out for at least 3 significant touches in order for it to be considered a valid trend line. And here you see price playing the reaction off of the 4th touch. So it is breaking out of the 4th touch, 4th swing high on this trend line. Okay, so here we have a little activity. Let me know in the chat or in the Q&A session if you think this trend line is valid or not. In this case, of course, we can all agree that price is moving downwards. So we are expecting to draw a descending trend line. So let me know if you think this trend line is valid or not. Okay, so this trend line is not valid because remember for descending trend lines, we want to make sure that we draw the line on top of the charts. Okay, next, let's take a look at drawing valid channels. So channels typically require at least 4 significant touches to be considered valid. You need 2 at the top and 2 at the bottom. But they don't have to be in consecutive order like what we see in the picture here. Okay, so here are some examples. We have a descending trend channel here. Remember, 2 touches on top, 2 touches below. And once again, take note of how clear the charts, or rather how clear the price movements should be. Here we have an ascending trend channel. So, of course, it doesn't have to be in consecutive order as we mentioned earlier. Doesn't have to be in consecutive order. You can have some price movement in the middle, but as long as there are 2 touches on top and 2 below, then it's considered a valid trend channel. So these are just some graphical tools that you can use when you're trying to identify a trend. And this is typically the first step whenever we want to analyze a chart. So if we have time after the slides, I'll go through maybe one setup. I think we only have time for 1 or 2 setups. So but I'll definitely go through the different steps that you can take to identify a trend and how exactly you can use that in your trading strategy. Okay. Next, we have the different indicators that you can use to identify the trend. So we're going to be talking about the different indicators that you guys can use, but let me know in the chat what are your favorite indicators to use. Yeah, just curious to know how many of you guys actually use some of these trend indicators. Firstly, we have the Ichimoku cloud. So I'll just briefly go through how exactly you can use the Ichimoku indicator. But I wanted to mention that this is not a webinar for Ichimoku strategies. So we have another webinar that is solely about how we can use Ichimoku, not just the cloud, but the different lines involved as well, that I'm going to talk about in the next few slides. So you can go ahead and take a look at that webinar instead. But for this webinar, I'll just be breaking down the different lines and giving you a summary of how exactly you can use it. Okay, so the Ichimoku Kinko Hyo is a technical analysis tool that's used in Forex trading. So it consists of several elements, several components, including the Tenkan-sen, the Kijun-sen, Senko span A and B, and the Chikou span. Okay, I hope I'm pronouncing those right. But basically, these lines include a 9-period average, 26-period average, average of these two averages, 52-period average, and a lagging closing price line. So the cloud is a key part of the indicator. And how people use Ichimoku for trading is basically 1, to identify trends, 2, as support and resistance, and 3, confirmation, as well as buy and sell signals. So if we're just looking at the cloud only, which is the most, I guess is the fastest way, because you just look at it at one glance, it tells you exactly what the indicator signals are. So over here, I'm telling you guys that when price is below the cloud, then the trend is downwards, or it's suggesting a downward trend. When the price is above the cloud, then the trend is typically upwards. Trend signals are strengthened if the cloud is moving in the same direction as the price. So for example, during an uptrend, the top of the cloud will be moving up, or during a downtrend, then the bottom of the cloud will be moving down. So the top of the cloud, the bottom of the cloud, these both have names as well. So you can see over here. So we have the Tenkan-sen, which is the conversion line, which is the average of the highest high and the lowest low over 9 periods. The Kijun-sen, or the standard line or baseline, is the average of the highest high and the lowest low over the past 26 periods. Chikou span, which is the lagging span, is the current closing price plotted 26 periods behind the current time. So these are pretty technical meanings of what the lines mean. So, but we typically will only look at the cloud. It depends on your own trading strategy. Okay, next we have explaining the lines. Oh, I didn't talk about the Senko span. Okay, so Senko span A, or the leading span A, is the average of the conversion line and the baseline plotted 26 periods ahead of the current time. And that is a leading indicator of the trend. For Senko span B, D is the average of the highest and the lowest low of the past 52 periods plotted 26 periods ahead of the current time and used as a leading indicator as well. Okay, next we have explaining the lines and identifying trends. So here we get into what each of the lines, or rather how you can use each of these lines. So the first way is to use Ichimoku to identify trends, which the Tenkan-sen and the Kijun-sen can help you with. So a bullish trend occurs when the Tenkan-sen is above the Kijun-sen. So Tenkan-sen is the conversion line and the Kijun-sen is the baseline. Yes, correct. Okay, so over here in the chart that I've included, the Tenkan-sen is the blue line or conversion line, and the Kijun-sen is the red line or the baseline. So bullish trend occurs when the blue line crosses above the red line. And then a bearish trend occurs when the blue line crosses below the red line. Okay, next, the second way is for support and resistance. So this is just extra. So the first way was to identify the trends. Now the second way is to identify potential support and resistance levels. So the Senko span A and B, which I mentioned earlier, are the leading indicators. These can determine support and resistance levels. So if the price is above Senko span A and B, then it's considered to be a bullish market. So in this case, Senko span A and B, as you can see in the screenshot that I took from TradingView, you can see that these outline the clouds. So it's basically used as the same way as I mentioned earlier. When price moves above the cloud, it's bullish. When price moves below the cloud, then it's considered bearish. So same thing, if price moves below Senko span A and B, it's considered a bearish market. And these lines can also act as resistance levels, since they are specific levels, as you can see here. Okay, so second use of Ichimoku, first use was to identify trends, and second use is as support and resistance. Okay, thirdly is for confirmation. So the Chikou span is used to confirm the signals that's generated by the Tenkan-sen, Kijun-sen, and Senko span. So the Chikou span is the lagging indicator here. And you can see I've shown you guys what it looks like on TradingView. So it confirms if it's above the current price, then it confirms a bullish trend. And if the blue line is below the price, then it is a bearish trend. So we just use this for confirmation of the trend. So after you've analyzed or you've gone through the first two steps, so you identify the trend and we analyze the different lines, then this would be the third way to confirm the trend. Okay. Next, we have as buy and sell signals. So these depend on the positions of the various components. So for example, if a buy signal is generated when the Tenkan-sen crosses above the Kijun-sen, and a sell signal is generated when the Tenkan-sen crosses below the Kijun-sen. Okay, so all of these different lines can, when you analyze each of them, if they all line up nicely, then you have a very strong either bearish or bullish signal. Okay, so how do we use the indicator, the Ichimoku indicator effectively? So the overall trend is up when the price is above the cloud and down when price is below the cloud. So traders will often just use the Ichimoku cloud as an area of support and resistance depending on the relative location of the price, which is what we talked about in the second step, and we've shown you how to do this as well. So the cloud provides support and resistance levels that can then be projected into the future. So this is what sets the Ichimoku cloud apart from the other technical indicators that only provide support and resistance levels for the current date and time. So as I mentioned earlier, we like to typically just look at the cloud if you are looking for an indicator that's very easy to read, or you cannot, you don't really have the time to analyze each of the lines. Ooh, okay, so yeah, as I mentioned, this is how we use it by just looking at the cloud strength. So price is moving below the cloud, giving us a bearish signal. Here, when price crosses over, this is where we see a trend reversal, and you can see exactly right when this happens, price moves in an uptrend, and it's also moving above the Ichimoku cloud. So it's all very bullish signals. So this is what you want to look for whenever you are using the Ichimoku cloud. Okay, so far, if there are any questions, feel free to let me know in the chat. Okay, if there are no questions, we'll move on to our next indicator that we're gonna look at. So in this example, we're gonna look at using the moving average indicator. So price XMA is a cross-trading technique that is quite simple to use. So it involves using two moving averages of different periods to analyze price movements and generate buy or sell signals. So if you're unfamiliar, just a brief introduction to moving average indicator. So the moving average is basically a smoothened line, as you can see here. It's a smooth line that represents the average price over a specific number of periods, of which you can control when you're using MT4, MT5, or TradingView. So it helps to smooth out price fluctuations and highlight the underlying trend. So there are a couple of steps for this strategy. Firstly, you choose two moving averages. For example, here we are using a shorter period moving average, which is 20-day, and a longer period moving average, 50-day. The buy signal occurs when the shorter moving average, so in our case, the 20-day, crosses above the longer moving average, suggesting a upward trend. So in that case, we would then consider buying. For a sell signal, when the shorter MA crosses below the longer MA, then it indicates a possible downward trend, and then we will consider selling. So simply put, if your 20-day moving average crosses above the 50-day moving average, it's a buy signal. If the 20-day moving average crosses below the 50-day moving average, it's then a sell signal. So this works best in trending markets, so either moving upwards or downwards. It can produce false signals in choppy or sideways markets, so it's essential to practice and consider other factors like market conditions, risk management, and other confirmation indicators before making these trading decisions. Okay, next, let's take a look at Golden Death Cross. So this is a trading strategy that's based on the intersection of two important moving averages on a price chart. So it's a term used to describe the point at which a shorter term moving average crosses above a longer term moving average. So it indicates a potential bullish trend reversal. Conversely, you can see over here, so when price moves above, it's positive, and in this case, over here, we can then expect it to be bearish. Okay, when the death cross, the death cross will be over here when the shorter term moving average crosses below the longer term moving average, then it indicates a potential bearish trend reversal. Okay, so over here we have the golden cross, and here we have the death cross. My last point is confirmation and analysis. So it's important to note that these signals are not foolproof, so you should be using them in combination with the different technical analysis tools as well, like Ichimoku, and a couple of indicators that we're going to talk about in the next few slides. Okay. Next, we have channels. So we already talked about this earlier, but here I've highlighted a resistance level from the previous touch on the trend channel. So at this level, this is my resistance, and you can see price from this swing high, price has actually touched this level, making it an overlap support. But then we see it drop down again, touch the bottom of the channel, and then it's moving within this channel. So since it's continuously moving, and you can see for a really long time, this has really clear upside, or rather upward pressure. And that's why once price breaks through this overlap support or now resistance, then we can say that we can expect it to continue within this upward channel. Okay, so let me know in the chat which one of these looks better to you. Yeah, so the first one definitely looks better. And here we're using a moving average, natural moving average. Okay, let me show you guys the next slide. So now I'm using the natural moving average, and you can see I completely agree the first one definitely looks better. And the reason for this is because price has touched this level many times before it crosses over. So this is actually maybe a better representation of what we can expect for a reversal, or rather how we can identify a trend reversal. Since price has touched it so many times, showing us a really clear upward movement, then whenever there is a crossover over the natural moving average, then we can expect the reversal to be pretty significant. Over here, it's not that this chart is bad. Of course, we're using the same indicator, it's showing us the same things, but the difference between the two is just basically the settings, which is why it doesn't fit as nicely as the first chart. So in this one, once price reverses over here, you can't really tell whether price is actually going to reverse or if it's going to continue in the upward trend. Double break. Simply put, we are just looking for a break out of the trend channel. So this is a very obvious sign that the trend is about to reverse. Once we see this very clear, so we have the natural moving average again, which is the black line, and we are also combining this with our trend channel. So as I mentioned earlier, we need 2 touches at least on top, 2 touches at the bottom at least. So very clear upward pressure here. Looks like it's going to continue. But how we know price is actually going to break out is once we have double confirmation from the crossover on the natural moving average and also breaking out of this ascending trend channel. Okay, so you can see that's exactly what happened. It fell really sharply after that. Okay, next we have confluence. So the first chart, I'm just using a ascending trend channel. And then over here, I've included the trend natural moving average. So by making use of more than one indicator, or I guess trend channel would be a graphical analysis tool. So by combining all of these tools, then you can really increase your chances of making profit or getting out of a trade if the trend reverses. So that's what we mean by confluence. Here we show you some more examples. From the previous slide, we only had the natural moving average as well as the ascending trend channel. Now we've included the Ichimoku cloud, also giving us bullish signal. And now I'm also using the golden cross or death cross technique. Okay, but all pretty bullish over here in this case. Next slide, I'm also using these same indicators here. It's just to show you guys what each of these mean. So because so many of our indicators are giving us this bullish signal, then we can expect price to continue within this ascending trend channel because there are no signs that it's going to break out. So here we can see that's exactly what it did. It bounced off of the bottom of the trend channel and it's continuing within it. Okay, let me know if there are any questions so far. Okay, I have a question. Does this work only for trending markets? So that's a really good question. And the answer to that is we typically would advise to only trade or go in for the trade when markets are trending. And the reason for this is because, and when I say trending, I mean upwards or downwards. Because if it's ranging, there's not much market movement and you cannot really make much money from ranging markets, if that makes sense, because the movements in the markets are what makes you your profits. So all of these techniques that I've gone through today are mostly for trending markets, or not mostly, are all for trending markets, because that's what we typically recommend you to go for, especially if you are a beginner trader, because it's easier to trade when prices are moving up or down as opposed to staying ranging. Okay, I hope that answered your question, but thank you so much for the question. Okay, let's move on. I just have a couple more slides and then I think we can call it a day. So next, let's go through a couple of disadvantages of trend trading and how exactly you can overcome these disadvantages. So firstly, we have false signals. So trend trading can generate false signals as well, especially during periods of market consolidation or trend reversals. So if you act on these incorrect trend assumptions, then it can definitely lead to losses. Next, we have late entries. So what we mean by this is when a trend following strategies may result in entering trades after the trend has already been established. So you can miss out on the initial price movement and potential profits. And then you might see yourself in a position where price is already reversing when you enter the trade. Choppiness is our third disadvantage. So although I mentioned that we are looking for trending markets, you want to stay away from really volatile or choppy markets because these trends tend to be short-lived and erratic, leading to frequent changes in direction and difficulty in capitalizing on sustained trends. So whipsaw trades is a phrase that describes when traders enter and exit positions quickly due to volatile price movements. So these can result in losses, and this typically occurs when rapid changes in price direction occur. So that's pretty similar to choppiness. So don't mistake, when I say trending markets, don't mistake that for choppy markets. Okay, limited profits in ranging markets. So this is also part of my answer to the question from earlier. So trend trading might struggle to generate profits in markets that lack a clear and sustained trend, because these trades may get caught in a range-bound price movement. Okay, requires timely decision making. So when you identify the start and the end of trends accurately, this is pretty difficult to do. So it requires timely decision making and constant monitoring, which may not suit all traders' lifestyles or availabilities. So it really depends on your own trading strategy, whether you are a scalper or if you're in it for the long run. Noisy price data is pretty related to choppiness, so I'll just briefly talk about it. In this case, we're talking about noisy price data or short-term fluctuations, leading to a misinterpretation of the underlying trend direction. So how exactly can we overcome these disadvantages? So to overcome these advantages, you can adopt a couple of strategies and techniques. Firstly would be confirmation signals. So we've talked about, for example, for Ichimoku, we're talking about the different lines and what they represent. So these can be used as confirmation signals, or you can use additional technical indicators or chart patterns like we saw earlier when we're talking about confluence and using different indicators to support a trade or to support a trend. So when you use multiple indicators and technical analysis tools to confirm your trend signals before entering a trade, it can help to filter out any false signals and also increase the accuracy of trade entries. Diversification. So you should combine trend trading with other trading styles or strategies to mitigate the risk and reduce reliance on a single approach. So pretty similar to what I talked about confluence. Next, time frame analysis. So I'll talk about this really quickly in the next few slides. Risk management, we talked about this as well, implementing strict risk management techniques such as setting stop loss, orders, and position sizing based on your risk tolerance. Backtesting and optimization, we have a webinar on this, so you can go ahead and take a look. And market monitoring, it's important. Basically, we're talking about fundamental analysis, and it's really important to regularly monitor the financial events and economic data releases. Okay, so I wanted to talk a bit about time frame analysis. Here we have a very unclear market structure on the M15 timeframe. And there's no clear movements in price. So I talked a bit about that in the previous slides when we're talking about, I think it was support and resistance levels. Next, when we change the same asset or the same price chart to a H1 view, we see it a lot clearer. So there's two criterion you should look out for. Firstly, clear swing high or swing low. Secondly, a clear trend between the starting and ending points. So you can see here I've added a little quote at the very basics. The clearer the swing low and swing high, the clearer the trend between these 2 points, then the more accurate your analysis will be. So this is just an intro, but we have an entire webinar on multi-time frame analysis. But basically, it just involves analyzing the market from multiple time frames. So that's what we're talking about. Okay, so a couple of things to look out for on the higher time frames. We have the key graphical levels, so your support and resistance levels that we mentioned earlier, trend lines, trend channels, breakouts of these trends, and then big moving averages. We talked about those, Ichimoku cloud, big Fibonacci levels, and price action. So what we mean by price action is past, present, future prices, and the momentum from previous bars to dictate your strategy. So you can see how this all ties in. Basically, as long as you use multiple indicators, look at the different time frames, then you can increase your chances of making a profitable trade and trading according to trends. Okay, that's all the time I have for today, and just nice, we are done with our slides. So thank you guys so much for joining me today. I hope you guys found it helpful, and I will see you guys next week. Bye!